Hello, everyone. Evening. Welcome to Project Options Cashflow Day 23. Right, today's day 23 over here. So, if you're joining me in the session over here, can you just drop a note, a comment, say hi? All right, so I know who's joining us in tonight's session so far. All right, great. Hi, Mary. Hi. Right, hi, Josephine. Yeah, hi, Maureen. Okay, today we're going to be talking and touching on the topic of option greeds. Okay, so to some of you, you may really want to switch off, but to some of you, it may find it interesting because this will tell you a little bit more insights into how option prices actually move. Right? That means when a stock price moves, how does it affect the option pricing over here? That's something we'll be discussing and learning in tonight's session. Okay, hi Jacqueline, hi Anthony, hi Gary. Okay, we just give a couple more minutes for more people to join us over the session so we can hit the maximum benefit we can reach for the short session tonight, I will assume, unless all of you have more questions for me. Okay, for those of you who are with us and joining us so far, do us the same favor every single day. All right, click on the share buttons, let your friends know what this is about. All right, what they will be able to learn over Project Options Cashflow and why they should be thinking about options as an investment tool for themselves. Okay. Hi, Christine. Okay, markets are relatively strong today, so we may see another strong opening, but we may experience a sell-off again somewhere in the middle of the day. So in recent days, the market trend has been very volatile. While you look at opening and closing prices, it may seem to have not moved much, but internally over the intraday period, it has actually had very, very wild swings on the upside and the downside. So that means if you look at the range of the day, that's when you see a very, very wide range. But otherwise, if you're only looking at the opening and closing, then you wouldn't be able to identify or see too much actually. All right, hi Kyung, hi Yiling. All right, now so let's get the session started for tonight. So once again, for those of you who have just joined us, all right, help us click the share button so the video gets shared out on your Facebook feed. It'll be good if you can let some of them know what the video is about as well. Okay, so welcome everyone to I'm Possible Investors, Project Options Cashflow, where we'll be conducting a topic on options trading every single day over the month of June. Okay, now, so just as a standard disclaimer, as per every session, give me a minute. Okay, as per every session over here, everything that's discussed is purely to inform you and bring more education to you in the form of investing and options as an investment tool. So any decisions that you make or trades that you take on in our suggestion over here is purely on your personal basis and do your own risk management, okay? All right, now, so today is day 23. We're going to be touching on the options greed. Now, I also conveniently call it the options alienware. Now, why do I call it the alienware? Because this is something along the lines of alien language when it comes to options trading. Many people trade options, but very few, can really get a good hang or understanding of how option greeds work. Now, for the benefit of my community and my students over here, right, the good thing about being a portfolio option seller is the fact that all these option Greeks aren't as important as what some may tell you about. Okay, now option Greeks are very, very important if you're a short-term option trader or you're a short-term option buyer, right? So you need to know all about the Greeks because you're trading very short-term. So you need to know how the option premiums will change when the stock starts to move to your advantage so you can achieve break even and profitability much sooner than you expect. Okay, that's what Greeks basically do. They tell you how option prices move, right? When the underlying stock moves in a certain direction. So today we'll discuss what are they, what are the most important ones that you should know about, what is the difference between them, what moves what. Yes, I said that right. What moves what? Yeah, right. Okay, right. And then how does it work if you're a buyer or a seller of options? And then we'll go to a quick summary. Okay. There we go. Let's go straight and dive deep into it over here. Now, the first one we're going to talk about today is called delta. Now, so what does delta do? Now, you can think of delta as if we compare stocks. Okay, now what we usually try to do is we compare stocks, a particular stock price movement to that of the index, which means if we compare Coca-Cola shares to the S&P 500, right, we would use this comparison data called the beta, right? So for stocks, we use this term called beta, right? Now the beta tells you roughly how much the stock would move if the S&P moves by a certain mark over here, right? Now, so if you get a beta of 1, that means the index has a beta of 1. So that means for every movement in the index, you'll get the same relative movement in the stock itself. Okay, now, so if the beta of the stock is 0.5, that means you're going to get half the move of the index itself. That's what it does for stocks. So delta does the same thing for beta in stocks. Okay, that means delta does the same thing for options as what beta does for stocks. So delta measures the change in option price when the stock price moves. Okay, now, so what it means is this: if you're trading a call option, okay, let me switch around the screen. It might make things a little bit easier. I want to switch around the screen between the PowerPoint slides as well as the trading platform. Okay, now, so we see this. Yeah, it's on this window. Okay, now, so what you're seeing on my screen right now is the option chains. So I'm just easily referencing a simple stock called Intel. So for Intel over here, right, you are bringing out the nearest expiration, which is Friday, 26th of June, right? And you can see this column over here called delta, all right? So delta for the call options, right? And then over this side, delta for the put options. So deltas are measured from 0 to 1 or 0 to -1. So for call options, it works from 0 to 1, the range, okay? And then for put options, it goes from 0 to -1, okay? Now, so let's say we focus on this particular call option, the 61 call. So the 61 call shows you a delta right now of 0.36. Okay, so it shows you a delta of 0.36. Now, what it means is this: if the stock goes up by $1, that means if Intel goes up by $1, right, the premium of this call option will change by roughly about 36 cents. That's what we mean by the delta moves the option premium. Okay, right now. So if we choose the 62 strike, okay, that means right now to buy the 62 call, you have to pay about 30 cents, right? But it only has a delta of 0.22. So that means even if the stock moves up by $1, your option premium will only go up by roughly about 22 cents over here. Okay, now, so that's what it means. Yeah, all right, now, but that's also assuming that it moves up $1 right at this particular moment. Okay, all right, now, so that's what delta does over here. So let's go now into the next one called gamma. All right, now, so what does gamma do? Right, I hope I'm sinking you right into the deep ocean right now. Yes, delta starts things off. Gamma complicates things. Okay, all right, now what does gamma mean? Gamma basically changes the delta, all right, when the stock price moves. Okay, all right, now, so delta measures the option premium change. Okay, so gamma measures the delta change. Okay, now why do we say this? Okay, why do we say this? Because, right, the closer the strike price gets to the stock price, okay, the higher the delta becomes. Okay, now what do I mean when I just said what I said? Give me a minute. Right, because, right, you should be seeing this. Now, as you can see over here, when the stock is at 60 right now, for a call strike that is $1 away, we have a delta that is 0.36. But for a $2 call option that is away from the stock price, we have a delta that is about 22 cents. Okay, now, and you can see the column next to it says gamma, right? So gamma over here says 12 for the 62 strike, which means if we get a $1 movement upwards, right, that would bring the 62 call strike $1 distance away from the stock price if it moves up by $1. Okay, I hope I haven't confused you here. So that means if the stock goes from 60 to 61, right, so up by $1, the 62 call strike will only be $1 away by then. Okay, now, and by then, the delta should have changed as well. So the question is changed to how much, right? And you can see this figure here saying 0.12, right? So that means when the stock goes up by $1, the delta of this particular call strike would have increased by 0.12, right, to make it 0.34, right, 0.34. Okay, so that's what it means. All right, okay, so gamma measures the change of the delta figure, right, when the stock price changes and it moves. Okay, so likewise, if it drops by $1, right, you would actually see the delta go down by about 0.12. Okay, right, so that's what the gamma figure tries to tell you. All right, next, let's go back to our PowerPoint. Next one up on the list is called the Vega. Right, Vega. Right now, so measures the change in option prices when the volatility changes. Okay, now, so Vega is what measures the changes in the option premiums when the volatility in the market, all right, actually changes. All right, because right over here on the right hand side of every expiry date, okay, let me minimize this. On the right hand side of every expiry date, you see all these percentage figures. All these percentage figures are what we call implied volatility, right? Implied volatility. Now, so when the markets are risky, when the markets are swinging all over the places, you'll see stocks with high volatility. All right, now, so as you can see, Intel has a volatility of about 39.89. Let me change it to a more boring company, right, which is Coca-Cola. You can see Coca-Cola has significantly lower volatility at 30.86. Can I find an even more boring one? Let's see, what's more boring than Coca-Cola? Yep, Colgate-Palmolive is even more boring, right? The implied volatility of Colgate-Palmolive is only 22%. Right now, how about riskier stock? Okay, now riskier stock we would say right now would probably be Zoom, right? Because it has a substantial up move, all right? It's shooting for the sky, all right? So obviously, any stock that's moving in exponential price movements packs on a lot of risk when things start to turn around, all right? Because there are many people who want to run for the exits at the same time. So you can see the implied volatility is 63% over here. Okay, now what does this mean? Okay, now what does this mean when it comes to implied volatility? It just means that you have to overpay when it comes to time value, right, for these options. Okay, right? That means the time value will cost a lot more, right, when it comes to options with high implied volatility. Okay, all right, so let's go back to Intel. Remember, anytime during the presentation, if you have questions or things that you do not understand, start leaving them in the comment box so I can pick them up, right, when I can do so. Okay, right. So now next one over here is theta. Right, theta measures the daily decay in option price as the expiration date draws nearer. So theta is basically the measure of the change in option prices day by day as time gets lesser and lesser over here. Okay, so this is good for the sellers, but bad for the buyers. Okay. Oops. Get back to my PowerPoint. Right now, so in more words and details, so delta measures how sensitive the option strike price is to the stock price movement and changes. So it measures the change in option price as the underlying asset, which is the stock price, changes and gives indication to the option trader of the expected movement for the options they are trading. So call options has a delta from 0 to 1, as I mentioned earlier. Put options has a delta which is going into negative zone from 0 to -1. So gamma, as I've also detailed earlier, gamma measures how sensitive the delta changes when the price of the stock price changes. Similar meaning will be the change in delta per stock price movement. Okay, now, so gamma is also higher for at the money when compared to in the money or out of the money. Okay, now gamma is actually smaller for longer expirations compared to shorter expiration options. Okay, now, so gamma is actually a very high figure when it comes to options that has a very short expiration date, which means, okay, at the money options, all right, at the money options, we'll see premium changes more significantly, right, for every dollar change on shorter term expiry as compared to the longer term expiry. Okay, that's what it's trying to imply over here. Now, next one over here is theta. Theta is the measure of time decay on the option. It tells you the theoretical amount, right, that an option will lose day by day as it moves closer and closer to expiration, with the assumption that price and volatility of the underlying asset does not change. Okay, so theta is higher for at the money options when compared to in the money and out of the money. Okay, right? That's because at the money options packs in the highest value for time value over here, right? That means highest premiums for value that you're not getting upfront. Okay, that means with no claim amounts over here. So for buy, call, and put options, you have a negative theta because that affects your profitability. Okay, for sell, call, and put option traders, that is actually good for you. Okay, because it brings the value of the option down, right? And as a seller, you want to see those options expire worthless, okay, or become cheaper. Okay, now, so just a simple way to measure a time decay effect, right? One way is to look at simply an option that expires on a longer term basis versus an option that expires on a shorter term basis. So let's say we take Disney, which is in my picture right now. Okay, you can see Disney for a 19 June expiry. Okay, all right. I did this example about 1 month ago. All right, let's take this more practical. Okay, let's take this on a real life example right now. Okay, all right. It may be more practical for all. Okay, so let's do this. Let's do Intel for 24 days. Let me minimize this, right, so you can see more items. 24 days versus 59 days. Okay, now, so to know what the time effect is going to be like when it comes to options, this is how you take a rough estimate and a rough guide. Okay, all right, now, so let's focus on, say, the 60 call. Okay, the 60 call over here. All right, now, so as you can see over here, if you're going to buy a 60 call which expires in 60 days time, you're going to pay somewhere along the lines of $3.55 maybe, right? So $3.55, which is somewhere in the middle, okay? Right now, so $3.55 for 60 days of time. Now, assuming, all right, 30 days have passed, okay? 30 days have passed, 1 month has passed, right? But Intel stock price didn't budge. It didn't move at all. That means it went up, it went down, it went up, it went down. In a month's time, it went all the way back to 60. That means it didn't move from our day one until now, 30 days later, right now. But what has changed is your option expiration, which was 59 days at the start, would now have lessened by almost an entire month, right now. So that would mean that it will be somewhere close to this one over here, which is 24 days to expiry. Or let's take something better, all right? Let's take something that's 30 days to expiry. So a month down the road, right, if the stock didn't move at all, right, the 60 put option will be worth somewhere along the lines of perhaps 285 to 290, right? 285 to 290. Okay, that's what it means. Okay, now, so you realize that paying 355 for 60 days, right, will only see it lose its value after 30 days to about 285. So 355 minus 285, that's going to be 50 cents, 60 cents, 70 cents, 70 cents, right? So you have lost 70 cents over here in the span of about 1 month, okay? So you lost 70 cents in the span of 1 month over here, right? Now, so you can see as well, the theta, right? The theta for this 60 strike call option, right, is around about 3 cents a day, right? 3 cents a day. Now, so if you look at it over here, you take 3 cents times 30 days, right? You're going to reach somewhere along the lines of 90 cents over here, right? So we're seeing about 50, 60, 70, 70 cents decay, right, from our comparison. So you can see somewhere along those lines. Yeah, okay, so that's how theta works. Every day when the expiration gets lesser by 1 day over here, right, the value of the option will actually drop, right, assuming that the stock price has not changed at all. Okay, so that's what theta is trying to tell you. Okay, all right, now, so those are the most important things that you must know as an option trader, right? So I would say the simplest one or the more important ones, if you really want to pick this up, right, would be delta, gamma, and theta. Right, now, why do I exclude Vega? Right, it's not as though Vega is not important, but it is very difficult to gauge how much volatility will actually change. Right now, because volatility will change only after the stock price moves, and depending on how fast and how severe the move is, right, the volatility will then reflect that amount. Okay, now, so only after that, then you would see the Vega effect. So by knowing the Vega, it doesn't really help you plan as much. Okay, now, but delta, gamma, and theta, all right, will be important if you're a short-term option buyer or maybe even a short-term option seller from a trading perspective. Okay, but again, once again, for portfolio option sellers like us and what we do, all right, in terms of generating our cash flow, then this, isn't really as important over here. Okay, now I've covered the main thing and gist that I want to cover in today's topic as well. Right, so like I said earlier, right, if you do have any questions, please start typing them in the comment section that you want me to clear up for you. Right, otherwise, right, there isn't much. Right, and it'll keep the session really short for today, actually. Right now, so this is the time. If you have any question, throw it up into the chat box, so I'll be able to help and assist you further. Okay, now, lastly, over here, as in summary, as an option buyer, right, you would be better off buying in the money options, right, to benefit from the delta changes for every dollar that the stock moves in the direction that you expect it to. Okay, now you will also be hurt by theta, right, because every day time gets lesser, right, it eats into your premium value, right. Now high delta and gamma, right, to negate the theta. Okay. Now, as an option seller, what you might want to do is you would rather sell out of the money options, right? Selling out of the money options means you get to benefit from the margin of safety for error. Okay, that means the stock needs to go a certain distance before you will get into any trouble, right? And on top of that, you get to benefit from every day that it takes to actually get to your sell strike. Okay, be it whether a call option or put option over here. Okay. All right. Questions. Right? Any questions in today's topic? Or I've totally alienated all of you who have joined me today. Okay, if you don't understand anything I mentioned about, all right, fret not. Okay, that means do not panic, because if you are within our community, that means you are in I'm Possible Investor. Right, knowing or not knowing these things doesn't significantly affect how you trade and how you generate cash flows. Okay, but I just wanted to throw this out there for those of you, who are constantly asking me every now and then with regards to delta and Greeks. Okay, so I just thought I'll dedicate a session over here to cover that topic, since the agenda is really about educating all of you on the topic and idea of options trading. Okay, all right. Now, so we've got some questions coming in. So let's take a look. First question from James. Okay, how do you select 3 days to expiry while waiting for earnings spike? James, maybe can you reword the question a little bit, because I don't really understand what you're trying to ask. So I'm afraid, my answer may not be accurate. Okay, my answer may not be accurate. So if you can rephrase with a little bit more detail, maybe I can help you with a more accurate reply. Okay. All right, Kane has a question over here. Hi, Terrence. Do we look at Vega on top of support and resistance levels? All right, when we are choosing which put strike to sell for short-term options. Again, Kane, what's your objective? All right. And Vega is really a lot about volatility over here. So if you had paid attention to what I said earlier, right, looking at Vega is a little bit redundant, right? Redundant because volatility spikes, right? That means if you're selling before it spikes, right, there is no way of knowing exactly how much it's going to spike by, right? Or if you're selling into high volatility, there's no real way into knowing whether how much the volatility would drop. So, paying too much attention into it, right, would it's kind of like spending time on things that are not relevant, or not say not relevant, but should not be the focus of your time, right? So, paying more attention to possibly the support and resistance level will make a lot more sense in this aspect. Okay, right, Kate? I hope I answered that question over here. Christine, all right, Christine's question. Right, can you show on the Think or Swim platform how do we know if we have over traded from our available funds? Christine, let me cover this in one of the videos that I'll be doing with the community, right? Because I think you're asking questions that are more specific to within our strategies and our community. So I will put that under one of my topics over here, and I'll cover it soon. Okay, all right, Christine. All right, so James came back. So, okay, now, so James basically says, I'm speculating on next day's positive earnings to position my trade. Okay, yes, James, if you're positioning something for the really short term on earnings trade, you already know that it's going to happen the next day, right? So make or break, you might want to choose a very short term expiry options. Right, one because you're paying less for it. Right, two because anything that happens before earnings is going to be costly anyway. Right, it's going to cost a lot because implied volatility is always going to be high. Right, so choosing the shorter term expiry fits the bill. Right, shortest term, cheapest option, yet still inflated pricing. So this way, I can't really understand that now. So, there are, and I understand a lot of school of thoughts who have been taking on very speculative plays when it comes to earnings, especially, the darlings right now, which are the technology sector. So many of them have reported their earnings over the current earning seasons, right? And many of them have spurred out of the gate. But do understand that when it comes to earnings trade over here, there are a lot of different elements that you want to look at because, yes, you may get it right. That means you may be positive on the earnings and it turned out really, really great, but the stock price may actually still fall, right? It may fall just because the CEO decides to dampen the spirit by talking about some negative elements in the next quarter with regards to his earnings call. Right, so sometimes it's very difficult to estimate that. Second, it may be a positive earnings, but it may not be enough to what the analyst expects or what the market wants. So it may also turn out as a negative result. So buying expensive things ahead of such an event, right, it's actually a very, very risky play. Right, it's actually a very, very risky play. Right, so unless you know how to structure a combination of trades, which it's something that we do over here, all right? Unless you specifically know how to create a low risk environment, right, to capture those profits if we are right, okay, then that makes earning speculation a little bit better over here. Now let me see if I can get you some examples. Okay, now I say this because earning seasons are over for most stocks, right? So let me see if I can find something significant enough to bring out a good example. All right. Give me a minute. All right, now, meanwhile, if you have any questions, do continue to do so, okay? All right, I'll answer them. All right, let's see. All right, as you can see over here, not much companies. LCB, Soho. Let's see Soho. Nah, that's too cheap. see if PayYX works. No, it's too cheap. I've got no examples here. It's tough because I've got no examples that are great enough. Lazy Boy and LZB. Right, let's just take a look at this, for example, over here to kind of try to bring out James' question. Now, James, if we just look at Lazy Boy over here, all right, now, so you can look at, let's assume there's weekly options on this, right? But can you see the implied volatility that you are paying right now? Oh, it's just gone up, right? It's, to the tune of 98%, right? 98% over here. Right now, that's just because, as you can see, yesterday, all right, was only 80%, but today it shot up to 90%. Right now, so at 98%, you're paying very expensive options over here. Right now, what do I mean when I say very expensive options? Right, that means if you think, all right, like for example, if you think that the stock price is going up, right, even for the 30 call option, right, 30 call option, you would have to pay around 130. All right, possibly 130 to buy this call option, and that will put your break-even price at 31.30. All right, 31.30, and the stock is trading at 27.80 right now. That means the stock would actually have to jump. Three will be 30.80. Yep, around 350. Right, it has to jump around 350 just for you to break even. Right, and a 350 jump on a stock that is trading at 27.80, right? It's almost close to a 12% jump in the stock price, right? Just on the earnings related play, right? So can you see the difficulty in the challenge over here, right? That means you're buying and paying for very expensive options over here, right? That kind of doesn't present a very good case or very good scenario. Now, how can I elaborate this further? Let's take a look. Let me find a stock that is possibly around the same stock price, but with much lower volatility. Maybe I can emphasize further on that. 27. Okay, now take a look at this, James. Now, can you see earlier we were seeing the Lazy Boy, right, which was also around 27.70, right? But now all I'm doing is I'm taking a much more boring company like Corning Inc., right? Okay, and the stock price is similar, which is 27.10, right? And going through the same expiry options, but can you see the same 30 strike call option is only worth around 20 cents, right? So the volatility here sits at 40%. Now, so what it means is you saw Lazy Boy has a implied volatility of 50% higher, right? That means almost 2 times more. But you can see that the option premiums that you're paying, right, was almost 10 times, 11 times more than what it should be like on a normal day, right? So that's event-driven related options expensiveness that we call it over here, right? So if you want to play on an earnings play, you better make sure you better be right. Okay, now when I say you make sure you better be right, that's because after the event, that means once the event becomes a fact, right, the volatility may actually drop, right? So if the volatility drops and it doesn't reach where you want it to go, right, what's going to happen is the premiums of those options are immediately going to deflate, right? And if it deflates to something along the lines of 20 cents, you just paid 130 to buy an option and tomorrow it's worth 20 cents. Can you imagine the amount of loss over here? All right, now, so yes, you can do it, but I'm just trying to highlight to you the dangers of doing so, okay? All right, James? I hope that helps you to understand a little bit better. Okay, now, so let's go to Zen's question. All right, Zen's question mentioned last time that it's best to select 0.8 delta when buying call options. So is this applicable when buying calls? How about selling calls and buying or selling puts? in theory over here, Zen, if you actually saw the PowerPoint slides that I mentioned just now, all right, over here. So that's where I say if you want to be a buyer, it will be better off buying in the money options. That means you're better off trying to buy options that has higher deltas, all right, higher deltas. Okay, now if you're a seller of options, it will make a lot more sense if you want to sell options that has lower deltas. Okay, lower deltas. So there's no exact science of figure because most of the time these judgments have to be made from things like support levels or resistance level to choose the strike price. Okay, right now, but otherwise, just in the money options, higher delta for buyers, and out of the money options, lower delta for sellers. Okay, right. I hope I just said that right. Forgot what I just said. Okay, all right, Zam. I hope that clears up your doubt. Kane, again, all right. Do you look at specific theta to decide which put option to sell? If not, all right, it's in Greeks. I just said that, Kane. I just said that, all right. For impossible investors, right? You may realize I've never even touched on the topic of Greeks. Why do I not do that? Because it's not important to us. All right, okay, it's not important to us. Okay, all right. Now, so it all depends on your style, right? And you realize when I've discussed it today, all right, I emphasize a lot that if you're a short-term option trader, you're a short-term option buyer, to be more specific, right? You need to know a lot into these Greeks over here, right? But otherwise, if you're a portfolio seller, all right, that means you know what stocks you want, you know exactly what strike prices you are picking out. Doesn't really matter anymore, right? All that matters is whether you can get the premiums you want for selling these options. That's all. All right, okay. All right, final question I see so far. Ikyong, right? In the past 20 days, we've gone through different strategies without consulting these Greeks. So when and how much does... Right, similar questions, okay? All right, now no worries. All right, just a similar answer to all the different forms of question. Again, if you're an option buyer, all right, so I think this question boils back down to this slide again. If you're an option buyer, try not to be a cheapskate over here by buying cheap options, right? You might actually want to pay for some options over here that has some claim value attached to it. So that will bring about a higher delta, right? And it will bring about a bigger delta or premium changes for every dollar that you are correct, okay? That you are correct. Okay, now, and then if you're an option seller, it will make a lot more sense to sell options with lower delta, right? Because you get the benefit of a margin for error, okay? And on top of that, the options are probably cheap to begin with. So, you get to benefit from the time decay, which is theta over here. Yeah, okay? Now, so I hope I clear up those doubts over there for most of you. Okay, any more questions before we sign off for today? All right, any more questions before we sign off for today? All right, now just before I go, all right, I want to find out just from all of you who have followed us through most of the 20 over days or into our third week right now. How many of you would like a live session? All right, that means a live session that is done once a week. Right? How many of you would actually like a live session which is done once a week? All right, where we actually pick out a stock. All right, we pick out a stock. All right, and then we discuss the fundamentals behind those stocks. Right, and then we will design or structure what is a possible option strategy to take advantage of the expectations on how we should trade the stock over here. Right, that means throughout the 30 days, we have covered various strategies like Ikyong have just mentioned. Which strategy would be best to reap out the biggest benefit for such a stock that we are discussing for a particular day. All right, now how many of you would like a session like that? All right, so that we do something like that once a week. All right, if you do over here, so we have 50 of you joining us from various channels. All right, so if you do like this, all right, type in "I want it." All right, I want it. Okay, into the comment section. All right, so I know that it will be something that is going to be very beneficial to those of you, right? And we'll dedicate the time to actually get something like that done. Okay, type down "I want it" over here. All right. All right, keep going over here. Okay, while I prepare the PowerPoints for the finale. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. All right, okay. Any more takers? Any more takers? Okay, now, so if you want it over here, do this and make sure you are you're gonna be informed, right? Which means you make sure that all of you are already inside our Telegram channel, right? Because just like the other promise that I made out to all of you earlier in the challenge, right? That I'll be placing one cash flow live trade once every week, right? So now I've just added another responsibility to my end, which is on top of that. That means there's a second session where we'll discuss a stock fundamentally during the week, all right, and what option strategy will be best to benefit from the stock itself, okay, and the direction we are looking at now. So that's two value-added sessions once a week over here, right, on my part, okay, for all of you to understand and debunk more about options trading as a whole, right? So if you're not already into our Telegram channel, please make sure you scan the QR code and add yourself into our Telegram channel. Okay, and if you have not cleared up or done the entire Project Options Cashflow, that means you have not gone through all the different strategies that we've discussed, please head over to our website, opt yourself in, all right, so you get familiar with all our option strategies before I commence the next part over here in the month of July. Okay, that means in the month of July, I'm going to kick in these things that I promised all of you over here. Right, and hopefully, all of you will assist us and help us to get the message out, right, and have more people join us during those sessions, because more people would mean more different stocks, right? So we'll be able to bring more value in terms of, sometimes we may even get all of you to suggest stocks for our session next week, right? So it's not just something that we're going to have planned, all right? We may even accept suggestions or stock suggestions from some of you. Right, we would have our analysis done for the following week, right, and then after that, bring out a strategy series to how you can benefit from trading that stock. Okay, right now. So if you're not done so for us today, please click the share button, share out the video so more people will be aware of Project Options Cashflow. Right. If not, thank you very much for joining me on day 23 over here. Tomorrow is going to be day 24. We're going to discuss the topic of options volatility. So it brings to us, the question of some of you asked, Terence, how do I know an options is cheap? How do I know an options is expensive? Today, towards the end, I talked a little bit about it when I was trying to explain to James about his question. Tomorrow, we'll dive deep into it properly. Okay, that means how does volatility affect option pricing? Should you sell when the volatility is higher, or should you sell when the volatility is lower? Right. So tomorrow, we're going to run a session on that. Okay, and I'm going to be the facilitator tomorrow. Yes, on my part. Okay, now, not that I'm going to disappear, but tomorrow I'm going to facilitate the session, because I'm going to have a coach of mine who's going to step in, all right, and share this particular topic with all of you. Okay, all right, now, so he's been doing a lot on volatility over here. So he's going to share the topic on options volatility. Okay, so I'm just going to feed in different pointers over here on what aspects you can look at, okay, from my experience. Okay, so join us in tomorrow's session. I'll still be here, right, at 9 p.m. Singapore time, GMT +8. Thank you very much for those of you who are joining us tonight once again, right? Sincerely, thank you from me to all of you. All right, do stay tuned for day 24 as we touch on the topic of options volatility. Okay, that's all for tonight's session. Good night, everyone. Have a lovely night. See ya. Bye-bye. All right, welcome, Yiling. Welcome. All right, bye-bye, Christine. All right, welcome, Kane. All right, welcome, Javon. Welcome, Maureen. All right, welcome, Zen. Bye.